Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is February 13th, 2025, and we're going to talk about inflation pressures and what that could mean for different assets. So starting out with the inflation data that's come out this week, we have core CPI, CPI, core PPI, and PPI. Now, CPI is Consumer Price Index and measuring the cost of goods that consumers spend money on. PPI is Producer Price Index and the cost that it takes to create the things that consumers spend money on, but the producer's level of it. So when PPI is rising, then the expectations are that we should see those prices either cost the company more and therefore reduce their margins, or passed on to consumers. And so PPI can be somewhat foreshadowing of CPI in the future months. So as we look at the data, every one of these numbers are showing higher. We're seeing higher numbers, higher than expectation or forecasted. We can see CPI, both core and regular, month over month and year over year, pushing us back to a 3% annualized rate. That is higher and hotter than what we should expect or wanted, at least according to the Federal Reserve. Now, the Federal Reserve, Chairman Powell, came out and said that don't worry about CPI. We focus on PCE, personal consumption and expenditure, which is fine, except for that PCE came in hotter last month as well, back the last week of January. PPI is now looking somewhat forward, and if we look at PPI, we revised the previous month's higher, and we outpaced expectations, except for core, which means we take out the energy cost of that. Overall, this is inflationary. It is rising. It is increasing. We have hotter inflation. So we can talk all we want about whether it is real or not, but the data shows that inflation is hot and rising. One of the ways we can test this is to see how the dollar is holding up against assets and how the dollar is holding up against other currencies. So what we're going to use, we'll use the S&P 500 ETF for equities. We'll use gold. We will use the euro, just to get a sense of what we're seeing in inflation or the dollar's purchasing power. So against the S&P 500, it's not just about the dollar's purchasing power, but as you can see, the S&P gained 1% today so far, and we are pushing back to retest these previous highs. That means dollar's purchasing power against equities is lower and pushing higher by about 1% in a single day. If we look at gold or gold futures in this, we can see a similar type of move. And we're looking at this move higher, and it's moved higher about 1%. So when we see the S&P gain 1% and gold gain 1%, it might be more dollar-centric. And then later today, we had a comment or a statement from President Trump saying that the Eurozone is not going to be given exemptions or waivers with the tariffs, and the euro has climbed and climbed and climbed 0.5%. Now, 0.5% in the euro or in currencies, you should be able to take that and create a 2 to 2.5 times leverage in the indexes. So the fact that we are at 0.4, 0.5, that's roughly going to be between 1 and 1.25% move up in equity. So every single one of these is moved in essence in lockstep based off their ratios, and therefore we're talking about the same move in the dollar seems to be pricing in the exact size of move in the euro, in gold, and in equities. That would tell me that this is inflationary and being driven based off the dollar's purchasing power, especially when we had PPI today, CPI yesterday, and discussions of tariffs, which are always inflationary. So this is pushing things higher and pushing things up and up and up. That is dollar weakness, euro strength, equity strength, and gold strength or commodity strength. So that being the case, what do we look for? If we're seeing inflation and inflation is here to stay and even rising faster than what we had expected month over month, year over year, then where will we look over the next few months and quarters and even the next year or two? And the main areas that we'd look for is we'd look for bonds as a hedge against inflation, gold as a hedge against inflation or precious metals, and I would say financials. So let's take a look at gold once again, then we'll do bonds, and we'll look at financials as a kind of a top level view of where we can put money in an inflationary market. So as we already looked at gold, gold is pushing higher. Gold just recently hit a record high, at least in the futures. This is a very aggressive climb, and we're seeing price push higher today. It hasn't cleared the new high. If this is the case, and gold is showing that we're going to continue to run and push back into 3,000 and higher, it'll be a record high for gold prices. Silver has not moved as far as quickly. And so silver might give us a better leverage opportunity where we can have less risk for more upside. I'm looking for silver to retest the previous highs while gold is making new record highs. And we could be looking at $35, $36 on silver, or another 10% move in silver, or SLV if you want to trade it in the ETF. Looking at bonds, starting with the ZN. The ZN sold off very aggressively yesterday on the auction and reversed the entire thing. This is a widening pattern and a reversal. It looks promising as an opportunity to step into bonds again. So even though in our deep currents portfolio and other things we got stopped out on bonds, this looks like a reversal and pretty strong with good volume today. It could continue to return into bullishness and push TLT, IEF, and others up. You can see a lot of that action happened overnight as there's gaps in the ETFs. But this pushed us all the way back to the monkey bar, and I'm looking for a move up to 92 on TLT. So we're talking about another 5% increase in bonds plus a dividend or an interest rate that is going to be paid with that as well. You could do shorter time frame with IEF, and there's that similar gap up, close higher. Now, if interest rates are going to remain high because we're going to have to fight inflation, then the financials should be doing well. And financials are near the tops. They're not breaking free yet, but we did put a high in just last week. This is a reversal pattern, a hammer with a follow through, a confirmation. And even if we're only looking at the move up to the high, there could be a little bit of trade in there, but I'm thinking that we could see this break free and duplicate another 10% move higher, just like we did from here up to here. So financials could be pushing up for another 10% higher move if we can clear the high, and especially if inflation stays high and interest rates stay high as well. To trade into individual equities, I would probably focus on the bigger companies like Citi and Morgan Stanley, even Bank of America and Visa if we continue to see consumers spend money. But I would likely be avoiding some of the regionals, at least until we see them bounce. If you take a look at the regional banks and say KRE, you can see that we're not getting that lift yet. Let that fade down and find a support level closer to 62, and then we can look for those to move higher. Otherwise, again, I'd be looking for the bigger banks, the bigger players nationwide rather than regional banks for that financial trade. And the last thing I'll throw out, even though it may be something you've heard over and over and over again, I do like utilities as a substitute for fixed income or bonds. And as we're looking at utilities, we didn't break free today, but we're sitting here near the short-term resistance. Looking at individual stocks and those that are breaking free and moving higher, you might take a look at Dominion. Dominion just cleared this resistance area that goes all the way back into December. It is a widening pattern. The breakout in Dominion looks like it's about $3 to $4 move, and so we could be headed back up to 60 on Dominion, looking for about a 7% return plus any dividend payments you would receive with Dominion. That's going to do it for me today. Have a fantastic day. We'll talk to you again next week on the afternoon video.